Hello everyone, welcome. This is Tim Hyder, and today you're about to watch a webinar presented by Oil and Gas IQ in conjunction with 8/8, an Aviva Group company. As you can see, the name of the webinar is the Post-Megaproject Era, 5 Key Actions to Reshape Project Delivery in a World of Energy Competition. Your presenters today are going to be Claire Colquhoun, CEO at 8/8, and Harry Benham, Director at Carberry Consulting. So, without further ado, Claire, over to you.
Thank you very much, Tim. So hello everybody. So my name is Claire Colquhoun. I'm the CEO of 8/8, an Aviva Group company. We have been delivering innovative solutions for contract risk management into the global oil and gas, mining, large infrastructure and power industries for several years, since 2000 actually. We're covering a very interesting and topical subject today. A brief overview of this probably before we get into the detail. So we're going to take a look at the mega project era rationale and performance review. Take a look at what we've learned, what are the key learnings as we emerge out the other end of this mega project era. And what's happening now, we're in a very changing industry landscape, a lot of energy competition, so we're going to touch on that. Most importantly, we're going to look then at a framework for project portfolio change, and then the giveaway at the end, 5 key actions for project efficiency in the competition era. So before we get into the detail, I'd just like Harry Benham to give a quick overview and introduction of himself.
Thanks, Claire. Thanks, Tim. Hi, everyone. Harry Benham. I've worked in the oil and gas industry for over 30 years now with BP and with Shell. Large part of that time was in major projects, contracting, procurement and commercial work, and also in some operations and downstream activities. So I'm giving a perspective here from having worked in the industry for that amount of time, and also in the some of the experience that I've had there in major projects. Thank you.
Okay, thanks Harry. Okay, so the subject that we're highlighting in today's webinar is the strategy of deploying mega projects to chase volume growth is unsustainable. And why are we saying that? Because it has resulted in commercial failure, even in a high-price oil market. So, Harry, to kick us off, tell me why you've come to this conclusion.
Okay, we've talked about the sort of the 5 key actions. What we're essentially going to say in this analysis then is that the industry itself is starting to and needs to move it strategically from a mindset really of scarcity and therefore maximisation of growth to one where energy competition is becoming a bigger factor in the strategy. So in this, the 5 key actions, it's the mindset or the strategy shift from volume, if you like, to efficiency, from a major infrastructure build into a much more efficiency and service build is the key point. From that, a number of things flow. The engineering model that many companies, IOCs and NOCs and independents, is impacted by this and needs to change more into a service and working more efficiently with suppliers. It needs to become more efficient and productive. Again, that shift will lead to improvement theoretically and in practice in terms of contracting and procurement and simplicity there. Indeed, the industry needs to start using, it needs to get into more productive and efficiency from the investment mode, needs to become much more adept at using planning tools and systems, much more professional there, less improvised. And it leads also into much more modular based systems around construction simplicity. So we're going to talk about why that shift needs to happen and then the impact that it would then have across that whole engineering, procurement, and construction and planning process and structure. Claire, you asked the question regarding we've seen a sort of an impact that the last decade of major investment has not particularly resulted in significant and effective growth. We need to talk a bit about that because that's the key change that needs to be made in the structure today of the industry, and it leads to these other models. So I think to do that, and why we would say that, why do we make that assertion, I need to take a step back and have a look at what's actually happened to the industry over the past 10 to 15 years in context.
Harry, could you explain a little bit more before you do that about what you mean by moving from a volume focus to an efficiency focus?
Okay, so let's step back to try and answer that question. We've seen that if we step back and look at the oil price that this chart shows, I think many people have looked, given what's happened in the last 2 years to the industry and the impact it's had, we need to try and put all of this in context. If we look back, say, 100 years or more, you actually see that the sort of average oil price, along with other commodities, has actually sat around about the $45, $50 mark in real terms in today. So what we're actually seeing in today's terms, although it feels painful, is actually more of a reversion to the mean price, if you like, and has been a standard. Now, there's many ways to interpret this chart. This presentation is not going to be about oil price prediction. We don't go there. That would be foolish in the extreme. What we're trying to say here, though, is that certainly over the period, the last decade, and a prior period, probably in the 70s and 80s, where there was a major spike in oil price, it has resulted in some major investment in oil and gas projects. Now, the one thing I would want people to take away from this chart as we go through the presentation is also, it is quite easy to slip into the notion that these spikes would have been supply related, maybe due to OPEC or to Gulf Wars or whatever. I think what we need to also reflect on is, in fact, that there is a significant amount of demand issues that lie behind that oil price, and that also, I think, impacts as to where we will probably be headed in the near future as well. So I think if we then move to the next slide, I just want to make a point that we're really focused quite a bit on what happened in the past decade or so in Megaproject and why that era may be coming to a close. Clearly, in that demand picture, both in the 80s and then the 90s and then out into the 2000s, a major story has been obviously the growth in China. You've got a significant amount of growth, which in that increase in demand at a time of growing but limited supply obviously caused a major amount of oil price spike. That's allowed a major era of investment to take place. And we're going to talk a bit about what's happened there. But just be aware that also if you take, again, a slightly longer view in terms of demand from the 70s onwards, on a secular basis, the actual demand has been declining. And so the hyper-growth in China over the past 10 years, which did cause a spike in the price, has again reverted back to some sort of mean in terms of the actual forward demand. So I think that the prior investment cycle we need to think about where that's now taken us and what actually occurred during that cycle.
So Harry, in an era where we all benefited from the incredible growth of China, how do you evaluate the performance in mega projects over that decade?
Yeah, so thanks, Claire. It's a good question. So let me try and, here's a busy slide, but I mean, again, I know people on the webinar can pause and look at this one, both from McKinsey. In that era, and from the 90s and through the 2000s, as we saw a major amount of kind of global growth and Chinese growth that we've seen, there was a large investment placed on the mega projects. Now, the mega projects in various infrastructures, mining, transportation and oil and gas, had the basis in the fact that many of the oil majors getting involved in major projects needed to obviously look for large reservoirs, for large volumes of growth to feed a declining reservoir stock and to actually increase revenue. So the tool of choice, if you like, the investment vehicle of choice was the major project. That meant that large reservoirs, large resources could be unlocked, and it played to the technical and capital strength of some of those companies, i.e. a source of potentially competitive advantage. So in theory, large price spikes led to large investment capital projects and hopefully led to actual volume. Didn't turn out that way, as the next slide, sorry, not the next slide, but the next panel shows. It's a busy slide. Again, but the McKinsey analysis from the database shows that across all those projects, infrastructure and oil and gas, the short answer when they did the analysis was that for these large projects, typically $1 billion+ in international, almost all of them overran to a certain extent. A substantial amount overran significantly, what they call fat tails. 20% were over 100% growth, but the average was 80% growth in terms of cost and in schedule 2 years late. So in terms of, if you talk about the highest level overview of that 10 to 20 years of investment in mega projects. The background data, the asset data, would tell you that it had proven to be ineffective deployment of capital in many instances. Not in all, there are some success stories, but on average, the performance there had not been efficient, had been a significant amount of overrun, both in terms of cost and of schedule. Another way to look at it then is to index over that period of, let's say, 2000, where most of this investment started, and you saw the growth in demand. We've got 5 indices there. Again, it's worth looking at these in a bit of detail for a second or two. As you can see, right at the top, CapEx, a major amount of investment in CapEx. You see 5 times increase over the period, which is something like, for all the major companies, this is a summary of, as you can see in the screen, of about 10 of some of the largest international oil companies. It would apply to some other companies at the broader range as well. You're seeing something like 40 to 50% of their capital base increased across that time. So there's a growth rate of about 15% a year. It's an amazing amount of capital spent at that time. Obviously, we know what happened in the next 2 years as they put into reverse, but that was the sort of trajectory of the industry at the time. The oil price, as we know, did spike, but even the oil price going up to $125, $140 a barrel in that time didn't achieve the same sort of level of increase as the capital invested. And upstream costs, often cited as one of the key causal factors of project inefficiency. Certainly there's been an uptick in certain sectors there. There were some hot sectors in drilling and maybe some specialist equipment. But in general terms, the increase in cost was not driving the CapEx, and probably the other way around. The interesting point then is, across that period in time, 2 other indices to be aware of. The gas price, and again this is where we start to talk in a little moment or two about energy competition. Not the same sort of level of price increase that we saw in oil, to very different looking commodities over some of that period and increasingly beyond. And oil production, for those majors at least who were obviously doing some of the more complicated and complex projects, was flat. So in terms of, again, evaluating the performance, a major amount of capital sunk into the ground, but on a net production basis, not the growth that was wanted, partly due to complexity, partly due to overruns and schedule overruns. So on a purely financial basis, if you take a step back and be objective about it, you have productivity declining as you put more capex in the ground for the same production. Your return on capital obviously declines even at the top of the cycle, worth remembering. Not now, of course, you've got capital, return on capital in single digits, 5, 6%. Even at the top, you were declining from 20 down to 15 and so on. Reserve replacement, production flat, as we said. Clearly now a negative free cash flow, but basically difficult free cash flow even at the top of the cycle, also given the dividend policy of some of the majors. And break-evens at the top of the cycle, at least in the $65 to $80 range, and probably some companies in that range, Chevron, for example, have mentioned in the past that 110 was the break-even around about 2013. Now we know that the outcome beyond that, if we put the clock forward 2 years, you see 400 billion of marginal projects have been cancelled. The reverse gear have been slammed on into the capex, and potentially a good thing. Because that 400 billion of marginal projects was probably going to be, given the base rate there, 600 billion outcome, and probably 2 or 3 years later than expected. So again, a massive amount of capital would have been put into these projects, and potentially not for the productive value we've talked about.
These are pretty stark numbers, Harry, and maybe they speak for themselves, but we really have to ask why. Why has this outcome come about? I mean, what do you see as the key causal factors?
Thanks. Yeah, I think, you know, there's 2 schools of thought here, broadly. I think there's what's been labelled by the industry, the managerial school, which actually says something. Look, these projects are difficult, and they were always going to be difficult. But then that's what large oil companies are about. And therefore it's about getting the planning and the systems and the organisations right, and it's about trying to sort of improve on those. These projects could have been good projects, if only we'd done the things right, got our lessons learned, had our database of challenges all sorted, and had the right sort of people managing them. I'm not of that school, because I think there's an enormous amount of literature, and there's an example here of one of the thought leaders in this space, Ben Fleeberg, a professor of megaprojects analysis and economics at Oxford University, and others like Ed Merrow of IPA, who's saying that really the complexity of these projects is a problem in themselves. It's inherent. Fleeberg did an analysis of hundreds of projects in things like dam infrastructure and road and transport infrastructure and oil and gas across 70 years, about 200 or 300 projects. And all of the big projects have the same characteristics. Once you get beyond a certain complexity and size, he labelled it $1 billion plus, and kind of development, and the projects placed over 2 or 3 countries. So it's got that complexity of combining things. Then all of them seem to fail in very similar ways. They were always 50, 60, 70% over budget, and some of them were runaways beyond that, 2 or 3 years late, and not paying back the capital investments. And that kind of performance didn't change over 70 years. So there's something fundamental. He talks about fragility. He says it arises when a big project, a big static investment is forced into doing what maybe was best left to something that was scalable. He even labelled it an iron law of mega projects over time, over budget, over and over again. And again, like the figures we saw from the McKinsey of the recent past, his longer span analysis showed 90% failure rate, overruns 50%, schedule delays, etc. Numbers we've seen before. So he's saying, in fact, there's something inherent. Once you, what theories of big, he says, fails to incorporate in the logic is that oversizing a system increases its complexity disproportionately. So despite the Goliath appearance of these projects, they're actually quite frail, and until they're actually complete, a 95% complete project is also not generating any revenue either. So it's a huge bet, especially if it's not coming in on time. Now, if we go just to sort of build on that very quickly, we kind of developed from that analysis of Fleeberg. It's a little bit complicated, but actually quite simple chart. In theory, projects are large because you want economies of scale, economies of size, and for simple projects, as you go from left to right on this chart, you could start to see costs on a unit basis come down as you produce more from not adding, you're doubling production maybe from only adding 20 or 30% to the cost base. So your unit cost in theory would come down. What Fleeberg and the others have said is yes, but if you then start adding in the complexity as these projects get bigger and bigger beyond this notional economy of size, the complexity starts to run away a little bit with the project. And so the sum of all that is beyond a certain size, and it can be the scale of it, or maybe the number of countries involved, or the number of partners involved. The complexity overcomes the benefits to the cost. Now, the cost reductions. In fact, there's a database of recent LNG projects from Oxford Analytica, which we show here in this slide, which actually shows a fairly similar chart. It shows the startup by year and then the dollars per ton cost of a number of LNG projects around the world. And as you go to the right there, some of these projects are becoming quite large as we get into the mega project era, etc. And the ones on the far right are very much mega project LNG projects. And you can start to see what happens there is that the economies of scale starts to get taken away from you. And you see on the right-hand panel a frustration being vented a little bit by the CEO of Woodside, one of the largest oil companies in Australia, saying, "Why we've spent 200 billion on LNG projects in Australia, but it should have been 100. It's taken us 5, 6, 7 years. Why can't it have taken 3?" So, and suddenly, you're seeing these big projects where we're supposed to have learned things, and suddenly we're seeing them cost $2,000 to $3,000 a ton, whereas in the past they used to cost $600, $700. What's happening here? It seems to be going in the opposite direction to what we're supposed to be happening. So there is some evidence there to show that there's this notion of once you get beyond a certain size, the complexity of these mega projects starts to make them inefficient and an ineffective way of putting CapEx in place.
So it's been a tortuous year for the industry, in particular this past 12 months with the landslide in oil prices. What would you say are the key challenges that the international oil companies are grappling with today, aside from the price?
Yeah, I mean, okay, so I'll try and keep this answer short. I would say it's going to be less CapEx going forward, and it's going to be more competition. So let me just expand on that very briefly, though. There's an interesting chart here from Accenture. It shows, again, we've seen this growth, as we talked about before, the mega project era, one of 15% growth per annum in capital investment there on the left-hand side, and that's oil projects. And a similar one on gas projects. We shouldn't forget a lot of this investment has been in gas. That trajectory, left to itself, would have gone to potentially $1 trillion plus a year, per year, starting next year. And clearly something about that investment cycle had to change. Looking forward, what Accenture have done is build together some scenarios based on the IEA and other groups, and a more likely upstream CapEx going forward is much more flat. It's going to be around the 0.5% to 1% growth increase, and that's because of revenue curtailment, but also because of a number of other issues that they see as in terms of like fossil fuel and efficiency and competition from other fuels. So I think what a number of, and of course suppliers to the industry need to think about is that the CapEx scenarios going forward, of course they can be wrong, but a reasonable set of scenarios for the moment is a much more modest capital investment regime, and therefore efficiency and other ways of finding and generating revenue is going to have to be found in terms of fuel sources. So that's the CapEx frame of it, and that's just purely on an oil and gas basis. If you look at the actual industry itself, there's going to be more competition. Now, there's a number of ways to get into this, and this isn't going to be a long discussion. It's very simply put is that there is a growth, and this was mentioned in the BP Statistical Review of 2015, of what they call technological energy. You already see things like two of the European utilities, like E.ON, splitting itself up into a parent group, which is focusing on offshore wind, and with Uniper, it's traditional fossil fuel business. And that's just a sign in the future. You see some other oil companies like Total talking about investing in solar, etc. That may or may not be something that plays out generally, but it's certainly a trend. What certainly has been a massive impact on the business has been the technological improvements in light tight oil, LTO, shale oil and shale gas. You can see the growth there from some BP charts. And from nowhere, really, in terms of overall volume, in terms of oil and gas, you see it take up somewhere between 5, 6, 7, 10% of the actual global total. Combined with the downturn in demand from China, you can see what that did to the price. And as you can see also, the demand growth, another thing to remember is that although a lot of people talk about renewables only being a small part of the energy mix, they are a large part of the growth mix. So if you look at the BP Statistical Review this year of 2015, you certainly see increases in supply of oil and gas to about 1 million barrels a day, but equally 1 million barrels a day increase in renewables. So a competitive landscape and new types, and the previous high price didn't just cause the investment flux, but it also caused the ability of alternatives to be able to be invested in as well. Finally, in competition, we should remember policy. Obviously, there's the Paris climate talks, etc. But equally, there's a number of companies who are suggesting to oil majors that, in fact, it's even more efficient for them to work on smaller projects in terms of economic basis, and we've just sort of talked about that. And on that basis, you can see that even up to $120 a barrel, actually just being more efficient with existing portfolios rather than investing in major infrastructure could be a lot more effective in terms of net economic benefit to shareholders. Obviously, there's a volume growth issue behind that, but clearly there's new sets of ideas out there that the industry will need to start thinking about as well. So value versus volume, coming back to your question. So at the end of all that, where does it leave us? Well, I've put a table here that's just broken the the industry groups into the national oil companies, international companies, independents. They're going to be following different models, potentially similar models, but slightly different. Clearly, the current model is NOCs are continuing to invest because countries like Iran are kind of re-establishing its infrastructure, and you've got Saudi Arabia looking to leverage its resources. IOCs are curbing investment. Independents are looking at where the break-even is. Primary sort of focus in the near term. CapEx still likely to be there from the NOCs. IOCs and independents is going to be maybe more about debt and dividends. CapEx will be then looked upon much more kind of critically, and as I said, there may well be the NOCs looking to work with those players in slightly different ways as well. But obviously the world looking forward, there's likely to be slightly different strategies pursued by each of those groups of oil companies. I just sort of say one last point on that, Brian. For the suppliers then, there's a slightly different set of opportunities, but it's likely to be a switch more into plant efficiency, maybe brownfield extension capability, engineering design support and equipment efficiency, that more than say the major infrastructure and major kind of construction phase that we've been in before.
Okay, it's really interesting, Harry. So let me just try and recap on your hypothesis so far. So I think what you're saying is that your hypothesis for growth in this post-megaproject era for the international oil companies would center on more effective project screening and then 5 dimensions to manage the portfolio more efficiently, with value focus taking priority over volume focus. And what you mean by that is that whilst you would take more projects into the portfolio that might have lower output than the mega ones, but that these would lend themselves to scalability. And then this would in turn result in greater use of standard design, standardized contract templates, dedicated and common project systems, and a simplified construction framework. And I have to say it makes a lot of sense. Indeed, Chevron and more recently BP seem to be moving in this direction already. Can you maybe shed a little bit more light on this, a little bit more detail?
Yeah, so you've said a large part of it, so I'll just try and fill in some of the edges there, but that's right. So maybe a different sort of leadership in where we're headed. Obviously the CapEx reverse and supplier price reductions, that's not a sustainable model. And equally, you can't solve complexity with more complexity. So there has to be something about moving to more maybe smaller, scalable, simpler designs, modular systems. A lot of this has been talked about before by the industry. It really has to start doing it now, and it has to start doing it as a basis rather than to the edges of some of these projects. So, for example, as shown on the slide, engineering, maybe a step back from complex scopes into more sort of assurance and control of contractor designs. Contracts themselves should start to become simpler and easier to make sure that the obligations and risks on either side of those contracts are simpler and more straightforward, and the scope simpler would work more easily. There's less risk involved. Construction should become again simpler. It's been a major factor in driving the costs. But you're not going to get there by just construction efficiency initiatives. It's going to have to happen by something more structural in the design. So, as we said at the start, a big start has got to be, we've got to be more robust in how we prune the portfolios. So biggest fragile, remember the philosophy there. So don't pursue the scale benefits in of themselves, really challenge that. Got to be more flexible and scalable. Recognise there is a volume issue there, but that's something that the industry has to get to grips with. Got to genuinely challenge design selections. And again, pursue some of these smaller projects in a more strategic way. Screen realism. There is now a deep source of data. You've seen some of these slides. They weren't there 10 years ago. They are there now. Got to be realistic about the chances of these major projects going forward and what the alternatives are, and avoid just padding estimates. That doesn't solve anything. And then again, get into the efficiency and the scalability and the design and standardization through design up front, and not take a mega project and then throw some standardization initiative at it in a way to try and fix it. That's not going to work. This has got to be done structurally. Okay, so looking at some specifics then, what would you say would be the impact on contracting strategies and how, say, the owner-operators will take projects to market? So, for example, would you think we would see a renewed use of lump sum contracting, reflecting this more simpler project world? So, yes, is the simple answer to that one. If we look at these actions for efficiency, we spent a lot of time talking about that movement of portfolio. That then lends itself to, if we start to simplify and start to focus and put more of the effort into those smaller range projects, and then leveraging the current asset base. Yes, the engineering model changes, you get more straightforward service with contractors. The contracts are simplified, they are very legalistic and heavyweight at the moment. They will lend themselves more to straightforward lump sums. In fact, that would be one measure as to whether this is working or not. Today, there's a range of complex incentive-based and hybrid models out there which suggest that we've got the complexity issues we're trying to deal with. And of course, you then have the productivity tools and systems that you can actually work with, which are difficult to work at the moment, given the complexity they're trying to deal with. As projects get simpler, then those tools, for a small amount of investment in some of these software and planning systems, there could be a big return to efficiency and productivity. What I mean by that? So like some of the current issues we've got in engineering standards, you've got in-house standards, you've got big scopes, there's constant revisions, backwards and forwards. That increases, that's one of the factors of complexity and cost. Large plants create large contracts, create large complexity. You have thousands of pages of contracts, thousands of drawings, a lot of rework, lots of correspondence for things to get misinterpreted and mistakes to be made. Management of change is critical, but complexity tends to overcome. And we have to start moving to something to tackle the disease, not the symptoms. And then often, because teams are stretched and the project's complicated, you have ad hoc and improvised contract systems, local kind of preferences, versus using professional systems, sometimes having to work with corporate systems that don't adapt well to the project circumstances, etc., etc. So we have to move to something that is therefore a lot simpler in organisation tools, and we've said this a number of times now. Move to that simpler model, move to maybe supporting the contractors more, less of the internal designs. Indeed, more lump sum contracts on standard templates, standard obligations, simple remuneration terms, keep things clearer, and use these professional systems and tools more effectively. They'll get to work on these simpler projects, and for limited investment should show a much greater return.
So okay, if we turn to a greater use of standard designs and standard contract templates, do you think the oil and gas world can learn from the manufacturing world in this regard?
Yeah, so the final piece is the construction complexity, a big cost element. If you look at a piece of work done by McKinsey in 2015, but also some work from the UK North Sea, 1970s, and another 1970s revival here. But clearly in that previous era, there was a lot of overrun and construction complexity due to late design changes, late delivery materials, very similar to the world we saw in the last decade as well, when you have this major surge in complexity in projects. As you can see in the chart on the right, during the sort of 90s and 2000s, if construction in these major infrastructure projects had followed the manufacturing, there would have been something like a 40% reduction in cost. We haven't seen it. There's been no improvement at all, which lends belief to the system that we're making large one-off complex investments and we're not able to then build that into learnings, etc. You have seen that sort of cost reduction in shale oil, for example, which is a much more technological-based way of doing the business. If you lift the lid on this slide up on a mega project, here's what they tend to look like. This is the model around about what would cost you $80 to $120 barrel sort of break-even price, and this is why. You have an owner team that grows in size and is already at 10%, but could grow more because of the complexity. You have engineering services, but there may be a slight imbalance there. Procured equipment tends to be one-off and therefore complex, and therefore again difficult to maintain cost control over. But clearly on construction and fabrication you've got a big chunk of cost, and when you include the overrun it starts to take a huge amount of effort to contain that cost. So you have a number of areas there where you can improve upon in terms of cost. If you were to take a much more manufacturing and simpler design approach, you're not going to be able to do much with that if you continue with the major investment. As a final example, let's take a sort of standard generic mega project time frame. Yes, they may be sanctioned. They're saying it's going to take 4 or 5 years, but the reality is they turn out to be 7 or 8 years. You have a bit of a runaway when you get into fabrication and construction for all the reasons we've talked about, and engineering and procurement can also be much more expensive than expected. If you can bring it down to a scalable project, going back to Peter Coleman's concern, you should be able to take major chunks out of it. Now, whether you can have these, we're probably going to have to. If you do go into scalable brownfield projects, you can definitely get into those step changes. I don't think we're in the world of trying to do incremental change to that top. You're having to take a totally different structural view of it to make a lasting impact.
Okay, Harry, fantastic discussion so far. Right, let's try and summarise the key points that you made.
Yeah, so very quickly then. So in this table, just some 4 or 5 elements of what we've tried to say. Key point is trying to move from a volume growth to efficiency and cost focus, getting back to the much more scalable and manageable project scoping, going for largest output, single plant, look for much more scalable, adaptable, value focus, and recognizing in a world of competition, not a world of just supply scarcity. Engineering will change from a general expertise spread across projects to be much more focused on working with contractors, possibly larger contractor teams, smaller owner teams. Contracting strategy hopefully starts to become less complex, more straightforward, based upon simple obligations and costs. Planning and systems, we've talked about this a bit, dedicated digital systems providing efficiency rather than just ad hoc and improvised based on each project. And construction needs to become much more scalable and modular and dedicated yards, for example, versus large-scale greenfield. So, in an essence, efficiency against volume, mega project era. It is complete for now. It may not come back to something anything like what it was, and a number of reasons we've discussed. Financial impacts were significantly problematic, even at the high cycle. Need to move from volume growth to one where we're looking at recognizing that the financial risk of these projects is too high. Need to find another way. The energy landscape is looking for more competition, more efficient ways of providing fuel. And not just solar and wind, etc., but from tight oil, from shale. Project proposals need to be pruned and really restructured. Step change and cost reduction needs a different mindset. So, focus on the value of the scalable designs, move from the scarcity and growth to the complexity and competition mindset, and then from this, the growth to the efficiency, change the portfolio, and the organisation and the processes behind that are critical, and we've talked about those a number of times.
Thank you very much, Harry.
Thank you.
Claire, Harry, thanks very much for your time today, and thanks very much for an enlightening and insightful presentation. A lot of food for thought there. As you can see, anybody that's been watching and listening today could contact our speakers today, and I'm sure they'd be able to field any queries that you'd like. So, Claire, Harry, once again, thanks so much for your time, and thanks to you, the viewer and listener as well, and we hope to see you all again soon.